Liz Pulliam Weston, Your Credit Score, How to Improve the Three-Digit Number That Shapes Your Financial Future. Welcome to a world where even a three-digit number can shape your financial well-being. Our mobile book summary turns the pages of Your Credit Score, How to Improve the Three-Digit Number That Shapes Your Financial Future by Liz Pulliam Weston, revealing a detailed explanation of credit scores and the key factors affecting it. Discover the contrast between FICO and VantageScores, their respective implications, and how to improve and maintain a favorable credit score. In the process, debunk several myths that surround credit management while mastering essential techniques that will help you sail smoothly through financial waters.
The secret world of credit scores. Credit scores have been a well-guarded secret until recently. In the 1950s, engineers Bill Fair and Earl Isaac developed a mathematical formula to predict creditworthiness, but the specific factors used to determine credit scores were hidden from consumers for decades. Thanks to the Fair Credit Reporting Act, Americans are now able to access their credit reports and scores from the three major credit bureaus. Lenders use credit scores to determine whether to loan money and at what interest rate. FICO scores range from 300 to 850, with scores above 700 being favorable and scores below 600 indicating high risk. It's crucial to handle credit problems because they not only affect creditworthiness but also the financial future. Factors influencing your credit score. FICO's formula explained. Your credit score is a crucial number that impacts your financial future. The Fair Isaac Corporation, FICO, algorithm calculates your score based on 5 factors. Payment history is a significant factor, accounting for 35% of your credit score. Late payments, collections, bankruptcy, and liens negatively impact your score. The amount of debt is another critical factor, comprising 30% of your score. High credit card balances and maxed-out accounts hurt your score. The age of your accounts influences 15% of your credit score. The longer your credit history is, the better your score. Lenders also look at the average age of all your accounts. Last credit application carries 10% weightage. Opening several accounts in a short period can lower your score. Every credit application authorizes a creditor to access your credit history, which can cost you points under some circumstances. Lastly, lenders prefer a balanced mix of credit types like installment loans and credit cards, constituting the remaining 10% of your score. Be aware of these factors to maintain a good credit score. VantageScore versus FICO. In 2006, the three major credit bureaus launched VantageScore as an alternative to FICO. VantageScore ranges from 501 to 990, dividing it into 5 categories: A, highest, to F, lowest, credit. Although VantageScore uses the same factors as FICO, it stresses on how much credit you've utilized and still have available. It outperforms FICO in some test cases but is yet to gain acceptance from rating agencies and mortgage finance agencies. Moreover, the accuracy of VantageScore in identifying defaulters is debatable. Despite its subtle variations, the quality of your credit report remains the cornerstone of any credit score calculation. Credit score improvement. If you have a poor credit score, there are steps you can take to improve it. Begin by ordering your reports from Experian, TransUnion, and Equifax and carefully checking your accounts for errors. Dispute any errors both in writing and online, as federal law requires credit bureaus to investigate these mistakes. Pay on time, as even one late payment can lower your score by up to 75 points, and reduce your debt by focusing on accounts closest to their credit limit. Keep your accounts open, as old accounts in good standing can add points to your score. With persistence and consistent effort, you can improve your credit score. Credit score myths. Many people fall for credit score myths, which can hurt their scores. Checking your credit report, shopping for rates, using credit, and seeking credit counseling may not harm your score as myths suggest. On the other hand, bankruptcy is the worst mark on your credit report but doesn't mean you can't get credit again. Many people obtain credit after their cases have been discharged, however, they pay steep interest rates. Lenders want to see evidence of your ability to use credit responsibly over time, hence, use your credit card, even if you pay off the balance every month. Finally, most lenders view credit consolidation and payment plans negatively. Surviving financial hardship. In the face of financial hardship, it's vital to stay calm and focus on long-term solutions. Taking out loans or cashing in retirement funds rarely works and may even worsen the problem. Instead, reduce your expenses by cutting back on non-essential items and taking on extra work to increase your income. Prioritize critical bills like rent, utilities, and medical expenses over credit cards and personal loans. Lastly, consider bankruptcy as an option, particularly if you're overrun with debt. Despite the stigma, it can provide much-needed relief and a chance for a fresh start. Protecting yourself from identity theft. Identity theft is a rampant crime that affects millions of people each year, causing significant financial loss and damage to credit scores. Thieves can easily steal personal information, which can lead to unauthorized transactions and fraudulent accounts. Even after their victims discover the crime, it can take months to resolve the issue and repair credit ratings. A simple act of leaving sensitive documents in the trash can make one vulnerable to identity theft. However, with preventive measures like shredding documents, avoiding carrying a social security card, locking mailboxes, and avoiding using mobile phones for sensitive discussions, one can minimize the risk of becoming a victim of identity theft. It's essential to be vigilant and take proactive measures to protect oneself from identity theft. The hidden link between credit scores and car insurance rates. Car insurance companies determine rates using credit reports since credit history is correlated with filing claims. Ways to control car insurance costs include avoiding certain claims, increasing deductibles, opting out of collision and comprehensive coverage for older cars, and shopping around for insurance. Car insurance rates are often determined based on credit reports. The reasoning behind this is unclear, but insurance companies claim that credit history is linked to the likelihood of filing claims. Surprisingly, studies show that individuals with high credit scores are less of a financial burden to their insurance companies than individuals with low scores. Although you may not be able to prevent your FICO score from being used, there are steps that you can take to control your car insurance costs, such as avoiding filing certain claims. Minor damages that can be easily paid for out of pocket should be fixed without involving your insurance company, which can prevent premium increases. Increasing your deductible significantly from $500 to $1,000 or more can also reduce your premiums. In addition, comprehensive and collision coverage may not be necessary for older vehicles where the costs of repairs exceed payouts from insurance agencies. Shopping around for quotes from multiple insurance companies is also recommended, as prices often vary by hundreds of dollars. By understanding credit scoring and learning how it really works, you can regain control over your finances and avoid or improve poor credit scores.
On your journey through this enlightening summary, you've gained valuable insights on credit scores and their critical influence on your financial life. Equipped with knowledge of FICO and VantageScores, you now understand the factors that impact your scores and have the know-how to maintain a healthy credit score. Along the way, you've unveiled and debunked popular myths about credit management. By implementing these lessons, you can confidently navigate your finances and avoid the turbulence of poor credit scores, ensuring a firm grasp on your financial future.